Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video I want to cover a way to help prevent you from getting swept out of good trades on big gap down days. So this has been a pretty crazy week, certainly for the S&Ps, and if you were long individual positions or long the SPYs, when the market gapped down the other day, it would have been really easy to get flushed out. But there's also an easy way to avoid getting flushed out, especially if you want to hold on to your good trades. So before I get into this, if you're just finding this video on YouTube or Facebook, please make sure that you like and share it, and know that you can get more videos just like this at marketgauge.com/tutorials. Also, follow us at one of our two Twitter handles, at MarketGauge or at Market Minute. And finally, if you're not already watching this in HD, all you have to do is change the setting in the lower right-hand corner, and it will be much clearer video. All right, so on to what to do when a market gaps down. Now, it's not just the market. It could be an individual stock. But I'm going to start, and I'm going to focus on the markets here, because if you can identify the right days not to be afraid to buy a dip, then that will improve your ability to be in the right stocks or hold on to the right stocks or ETFs as well. So the first thing we want to look at is where the gap occurs, or where the low of the day occurs in the first few minutes of the day. So in this case, it's a big drop down, but just take a look to the left, and you can see that while it may not be a perfect level of support or breaking point, there is some support there. So the second thing you want to do is see what's going on with the other markets. So we like to look at four markets together. I call them the market watch. So I was just showing you the SPYs. Let's take a look at where the Qs were on their daily chart. So they gapped down to this level right here on that day, and you can see that too has been an important level of support. Finally, where was the IWM? So the IWM didn't break down nearly as hard, and in fact, it was sitting right on this pink line, which is the 10-day moving average. But even if you're not having a big fan of the 10-day moving average, you can see that it hadn't completely broken. Finally, if we look at the Dow was sitting right on the blue line, which for me is that 50-day moving average, and lining up with this area right here. So right off the bat, you know that we're not in a complete free fall, although the big gap down in SPYs really should have been enough with a 4 or 5 day consolidation to really break the back of the bulls and have this thing going lower. But here's the key, the opening range. So I'm going to take these charts and go to a 5-minute chart, and we're going to take a look at that day on a 5-minute chart. Let's go right back here. Here's what the gap looked like on a 5-minute chart in the SPYs. Pretty ugly gap down. So the first thing you want to do, and I know for some people this can be painful or torturous, but it doesn't have to be. Once you understand how to use the opening range, you'll feel much more comfortable waiting. And you should wait at a minimum for 5 minutes if you get a gap against you. So that means you're going to let the first 5-minute bar determine which way that market is going to go for the day. Now, as you get used to this, I suspect, like me, you'll start to prefer the 30-minute opening range. In other words, what's the high or the low of the day at 10 o'clock? And that level is your 30-minute opening range. And until the market breaks down below that 30-minute opening range, you want to give the market a chance to come back. Now, this doesn't mean that just because it gapped down, it has to come all the way back. We know that does not always happen. But more often than you might expect, the market will come back higher than what would have happened if you were just to dump it right on the open. Now, you can take this to another level as well and do the same analysis that I just did with the daily chart. What are all the other three charts doing? Are they also breaking out of its 5-minute range? Did they also break out of their 30-minute opening range? And if the answer is yes, then that is an indication that this could have been one of those days where the market has just gotten overextended, and a knee-jerk reaction will actually cause it to go right back, and in some cases, like we've seen this week, continue even higher. So I've shown you this on individual or on the markets. it's even more powerful on individual stocks when it's happening with the general market. Now, I started this video by saying keep yourself in or prevent getting swept out of your good trades. Just because the market gaps down and then starts to head higher doesn't mean that every stock is going to recover with the market. But the strongest stocks in the market, the ones you want to stay in, the ones you don't want to get swept out of, generally will, and oftentimes will even start to outperform the market. Oftentimes, the gap down will filter out the weak stocks from the strong stocks. So if you have a stock that doesn't recover with the market and does break down from the 30-minute opening range, you should consider that one in trouble, and there is a time to get out. That's probably it. All right, so there's a lot more you can do with the opening range, and there are more specific patterns in terms of how you know how far above the opening range it has to get in order to qualify as a breakout. But for right now, if all you do is focus on this 30-minute opening range, it will help you stay in, as I said, the strong stocks that are just getting whacked around by the market. And the key to this is, as we've seen this week, is oftentimes when after the market's had a scare or your stock has had a scare, it's flushed out all the weak holders and it leaves it open to have the tremendous run that the equities have had this week. One final thought, the opening range obviously is not just for gap downs. You can see that the follow-through day, the next day, the market consolidated near the high of its 30-minute opening range, and once it got going, it had another ramp up, and as you can see, gapped higher on the current day here. So all you had to do, this all started with having the confidence to not get shaken out at that gap down. So I hope that helps. And if you like this idea, I'll probably put a link to a training we're going to do tonight, not specifically on the opening range, but on setups that give you the ability to be in stocks in days where you have the potential to all just use this simple opening range process to find explosive moves like the ones we've seen here. Hope that helps. I'll see you in the next video.